What is the number one thing you can do as a borrower to get the absolute lowest interest rate? That answer next. Hey there, my name is Ryan Skaggs, and this is the Mortgage Minute. Thank you so much for tuning in. This channel is dedicated to everything mortgage, real estate, and interest rates. We're going to dive into those interest rates first. The average 30-year fixed, according to Freddie Mac, is down to 2.98. Big drop from week to week. As you've heard me in the past, I've been talking about, over 3% on the average 30-year fix. You can check out the link below to the average 30-year fixed chart, according to Freddie Mac. While you're down there, hit that like button, hit that subscribe. I'd be forever grateful for the subscribe, and hit that bell icon to be notified as I'm putting out weekly videos. Now, that 2.98 is not indicative of where we're at today, just a couple days later, as Wednesday, the 10th of November, consumer price index and some other data came out and really scared the heck out of the market that inflation is just tearing through the market, even though we've got a good equity market, but that inflation typically will help rates rise when we see that. And so that really has pushed rates up later this week. So you're going to likely see a much higher rate next week if we stay on this same trend. So with that said, that's our interest rate update. We want to talk about today is the absolute number one thing you can do to get the best rate. And that is credit scores. And today we're really going to talk about credit utilization, the amount of credit that you have available to you and what you're utilizing, what you're using. And I've talked about this. I talk about this kind of day to day, but I probably had 4 conversations a day just on this topic. So I thought, why not get this into a video as well to help explain? So now, first and foremost, I'm going to take you onto the screen here. So we're going to be able to see a quick scenario of what it looks like for an average borrower. So this borrower already has a mortgage. We've got some student loans, and then we've got just a couple of credit cards. So really, the credit cards is where I want to dive into, because that's where you're utilizing a revolving credit line. So in this case, I'm going to give you an example of what if we paid down the credit cards to be about 50% of what the limit is, right? In this case, we got a $6,700 limit. We pay it down to, let's just say, $3,200, and that would be just under 50%. Now, in this case, just one credit card being paid below, it was currently above 90%, getting in below 50. That has a roughly a less than 10-point jump, not significant. But when you actually go and look at a possibility of getting your score increased by getting all of your cards below that, now all of a sudden, let's look at, that scenario. So now paying that down, and whoa, that just made a significant effect where we see the credit score go all the way up to almost 720 here. Now, these are all just projections. And this just gives you an idea of what would it look like if you did some of these things. So by doing so, as you can see here on the right-hand side, about $6,000 of capital, and you put that towards these credit cards that had a higher balance. And guess what? You're going to likely see an increase in score. Now, I'm going to take you back, and take off the screen here, because what I do want to talk about is sometimes these credit card balances, you're paying them in full. You get a statement, let's say a $5,000 credit card, but you spent $4,500. Well, when that statement generates, it looks like you owe $4,500, which you do. Then you pay it off. But when it answers to the credit agencies, it is literally towards the end of your utilization. You're using a majority, 90% of your available credit. Now, if you made payments on a weekly basis, let's say you spend $1,000, you pay down $1,000, you spend $1,000, you pay down $1,000. Whenever that statement cycle happens, it's likely only going to show a 0 or up to $1,000 payment. And in doing so, you're always going to be below, in this scenario, below a 20% utilization. So in my mind, typically the score would go up in those cases, versus when you are letting the statement cycle run, you owe most of what the card has available for you, your score is likely going to go down. So understanding the credit utilization and just your spending habits is so incredibly important. that could matter in terms of interest rate by an eighth, a quarter, three eighths, a half sometimes, depending upon your scenario. Now, again, just being smart about those spending habits is really the key takeaway where I want you to be is using the credit cards. Okay. Using your debit card instead of the credit card. Okay, fine. Right. Just my opinion. But in these cases, a lot of people want to get the points and a lot of people don't understand, especially those getting ready to buy a home, of exactly what that utilization really does to your credit score. So in my example, you could see we raised the credit score, potentially got a higher projected score over 25 points by just some simple pay downs or some simple utilization of those cards. So, my name is Ryan Skaggs. This is the Mortgage Minute. Thank you so much for tuning in. Happy Veterans Day to all those from just a few days ago. Thank you for your service. I appreciate you all tuning into the channel and hearing a little bit about more of the mortgage world, real estate, and interest rates. Thank you again, and we'll see each other again very, very soon.